Hey everyone, George here. So if you're a construction business owner that's always looking to scale, chances are you've probably given some thought at some point about buying or acquiring another construction business. It could have been another contracting company, a specialty trade shop, a book of contracts, or even a competitor with crews and equipment. And if you ever did that seriously, you probably spent real money on accountants, lawyers, or consultants. But here's the question nobody asks until the deal collapses. What happens to all that money you spent when the deal never closes? Today I'm going to break down which acquisition costs are lost forever, which ones become capital losses, and how contractors can salvage a lot of the deductions from failed deals. So if you're serious about the M&A game, like buying another construction company to help scale your current business, this is an episode you don't want to miss. So let's get started. So let's talk through a realistic example. Let's say you own a construction business and you're tired of the slow growth. You really want to ramp things up, speed things up. So you want to buy an existing construction business to help you do that. So let's say you're already down that path and you spent $15,000 researching the industry and what might help you really scale. You identified a target company, entered into a purchase agreement, and spent another $35,000 on legal, accounting, and other transaction costs for this merger. And then for whatever reason in your due diligence, the whole thing falls apart. No closing, no business, no revenue. So you're sitting there thinking, I can still deduct all this, right? The answer is it depends and what type of costs we're talking about. So bucket number one is initial investigation costs. These are costs you incur before buying a specific business. It includes industry research, market analysis, preliminary consultant fees, early feasibility studies. If the deal had closed, these would be treated as startup costs, in which case you could deduct up to $5,000. And the remainder you'd have to amortize and deduct over a 180-month period, so 15 years. But here's the catch. If the deal never closes and you never started that business, those costs would be viewed as personal and therefore non-deductible. So unfortunately, they'd be gone. There'd be no write-off, no amortization. So the question would be, can you recover those costs? And the answer is sometimes yes. If you later, for example, pursue another business in the same field, you may be able to roll those costs into the new acquired business and basically deduct and amortize them there. So for example, if your first target was an electrical contractor company and the deal fell apart, and then eventually a few months down the line, you found another target, another electrical contractor business that you wanted to acquire and you acquired them, you could effectively roll it up and deduct it all as the same startup expenses between both businesses. And again, you deduct $5,000 right off the bat, and the remainder you'd have to capitalize and amortize over a 15-year period. But let's say if you're looking for an electrical contractor company and instead, and when that failed the first go around, and you now pivoted into a whole new real estate development, that would be an entirely separate line of work, and therefore you would not be able to roll those costs into that second venture. So unfortunately, those first round of startup costs will be lost permanently. Now, those startup costs were bucket number one. What's bucket number two? Bucket number two are acquisition specific costs, and these are usually the larger dollar items. This is usually once you pick a target, sign a purchase agreement, and start the formal due diligence process. In this case, your legal, accounting, and transaction costs become startup acquisition costs. These are things like attorney fees, CPA quality of earnings reports, deal structuring costs, investment banker fees. The deal closes, these costs get capitalized into the whole deal, into the whole purchase, and recovered over time. But at this point in the process, if the deal fails, the one caveat, the one good news is that these become a capital loss. So real quick, how do capital losses work in this case? Because the acquisition agreement usually exists for less than 1 year, these are generally treated as short-term capital losses. That means you can use them to offset any capital gains, plus deduct up to $3,000 a year of ordinary income, and any unused capital losses you can roll forward indefinitely. So if you had $35,000 in failed acquisition costs, the one good thing is that you haven't lost the deduction. They've just moved over to the capital loss bucket. That's a big difference compared to the early investigation costs. So the one common mistake or pitfall is that contractors assume, all this money I'm spending just right off the bat becomes tax deductible. Unfortunately, that's not true. So it is, the tax code does break it up into three buckets, which are early investigation costs, startup costs, and transaction costs. Even though it feels like you're writing all the same check, they're treated very differently. So again, if you're ever going through one of these, mergers are a great way to scale. They help add economies of scale to your current staff. They help buy out your competitors. They help add specialty skills you previously didn't offer. They help get into new verticals. There's definitely risks involved with mergers, but they are a great way to scale for sure if you're tired of growing very slowly. So you definitely want advisors, CPAs, attorneys, consultants, all them who have dealt with M&As before, especially in the construction space. Otherwise, you might be missing on a lot of opportunities. So again, to make full circle on all this, bring this all home, early investigation costs are only deductible if a similar business is later acquired. Otherwise, they are non-deductible personal expenses. Later acquisition costs are capitalized once you commit to the deal and become a capital loss if the deal fails. And again, above all else, documentation matters. Timing, purpose, scope of work. If you classify things incorrectly, it could really cause you a headache in the event of an audit. So if you're a contractor thinking about buying another business, selling your company, or exploring growth through acquisition, you need tax planning before the deal starts, not after it falls apart. Because the IRS doesn't care about how painful the deal was. They only care about if it was properly classified and treated. If any of this applies to you, our calendar link is down in the show notes. Book a time and hope to see you in the next one.